Good afternoon, everyone. Hope you're doing well. Sorry, it's been a while since I've done a video update. If you're a client, as you know, we've been extremely busy moving around a lot of investments. There's been lots happening in the markets. I wish I had a chance to update you beforehand on some of these trends, such as the US dollar pumping, or in the short term pumping, and the massive bounce in China, which we'll talk about later. But firstly, last night there was a quote, stunning jobs report coming out of the US, a record surge in government workers. Now, the devil is in the details. If we have a look down here, you can see that. So, if you're not familiar, seasonally adjusted numbers. So, when governments report things like job numbers, they seasonally adjust them. So, for example, there might be a whole bunch of people getting jobs or jobs created in December because it's Christmas and people are getting second jobs, or a lot of retail and stuff like that. They're hiring extra people, so they seasonally adjust them. But if you don't seasonally adjust them and count the actual numbers, government workers soared by 918,000, and private sector workers plunged by 458,000. We can see it in the chart here. So all that's happening is the government is going into massive debt, and this is the same thing we're doing in Australia with our state governments now are accumulating massive debt. Governments going into debt to hire people, and private sector, and well, it's certainly in the month of September, private sector losing jobs. And if we have a bit more of a scroll, we can see Zero Hedge shows the unemployment rate. The red line is the blue line is the unemployment rate. So the unemployment rate came down from 4.2% to what's that, 4.1 or 4 and a bit. They usually round it. And of course, if they didn't add all those government workers, the unemployment rate would have spiked. So we do have an election, they do have an election next month. So very curious that was done right before the election. But I'll leave that to you if you want to say that that's an accident, or maybe it's a little bit of a plan to keep the current administration going. But this is what should be a little bit scary. Here's total US government debt, and we can see in a 3-day period there, the US added $345 billion of debt in 3 days. Nice little spike there. Now at 35.7 trillion. Keep in mind that's well over 50 trillion Australian dollars of debt. So they're accumulating debt, and we've talked about this many times before in other videos, accumulating debt at an accelerating pace. And if we come across to, this might seem kind of strange, but I've talked with, and by the way, this is not investment advice. If you'd like investment advice, please reach out for a private chat. And I'm just letting people know what my clients and I are doing. And if you're a client of mine, for the last couple of weeks, I've been talking about so this is the US dollar index. And I've been talking about the potential of the US dollar bottoming and having a bit of a bounce. You can see it was in this declining channel, this falling wedge, positive divergence on the momentum indicators. And I drew a bunch of dotted lines because I was trying to draw the most, not extreme, but the different trends that it could potentially be in just in case I'm wrong, and all the touches there. And you can see now it's broken above that 102 level with a nice close at 102.48 last night. So the US dollar is showing signs that it's bottoming, and that's generally a negative for most other major asset classes. If the US dollar is going up, it does put downward pressure on other things. If you're a client of mine, many of you know that we've been buying T-bill to hedge US dollar strength, to hedge our portfolios. I don't think it's wise for us to be shorting markets given this high inflation environment and this stocks breaking out, especially the Australian market. Again, not investment advice, just looking at the charts, looking at the technicals. But speaking of stimulus, if any of you were questioning as to whether governments can pump up stock markets, well, the Chinese over the last week or two, they have certainly done that. So the Chinese market was closed for 4 days, but what wasn't closed were the ETFs that we were participating in, that you can buy on the Aussie market. Again, not advice to buy these, but have a look. So CETF, which holds the top 50 companies in China, you can see it hit a low on the 19th of September. And look at that, went up 37, 38%. It is actually up 39% at one point. and then CNew, which is China new tech, new companies. You can see on the 24th of September, over a space of a few days, up 47%. So these are massive pumps in the Chinese market, and it's very what they've done is very confusing. But in short, so I'll read the part. So they're basically lowering interest rates, lowering reserve requirements for banks, lowering mortgage rates, and then most important to the stock market, although I guess it's all important to the stock market, but um, have a quick read of this. So what they're saying is the People's Bank of China, so their Reserve Bank of Australia, their central bank, is creating a pair of new structural monetary policy tools to support the stock market. Eligible institutional investors will be able to borrow liquid assets such as treasury bonds and central bank bills directly from the central bank, so from their Reserve Bank of Australia, using assets like stock exchange traded funds, ETFs, which is what we buy as investors, as collateral, and then sell them to get cash. They need to invest more in equity markets. So I understand you're probably thinking that makes no sense whatsoever. Um, the it's quite complicated, but if you'd like to delve into it further, please reach out for a private chat, because it would probably be a half an hour video on its own. But in short, the Chinese government, the Chinese central banks are they're basically providing more liquidity, more dollars to be borrowed, to be pumped into the stock market and real estate market. So they're basically just pumping everything up. And if you don't believe me, check out the 47% move in that ETF and the 37% move in the top 50 companies in China, 38% move from high to low. Well, even more if you were smart enough to get the high. So the Chinese absolutely pumped things up. I'm disappointed I couldn't get more clients into that trade. It all happened very quickly. But it also had a positive effect on miners, because obviously if China is, if they're pumping up their real estate market, so there was, if you read through some of these articles, I'll talk about, boost for their real estate market. Obviously that's going to be good for mining and metals, because the Chinese will be buying more of the stuff we dig out of the ground. And if we have a look at, say, the copper price, you can, and the charts, this is something I talked about in a video a few weeks ago. I showed, she did a video about mining stocks being potentially underpriced, and we had a look at the copper price. You can see the chart as your friend. You can see a couple of weeks ago, the copper price, which is very economically sensitive, being an important industrial metal, you can see from high to low, dropped 25% from May this year to August. And you can see it was in this downtrend channel. It popped out of the channel. We've talked about these before, and popped out of the channel, returned to the scene of the crime. Up she goes, and obviously, I guess the market was anticipating some stimulus from China, and up goes the copper price. And since the low in August, copper price up 16%, and at one point was up 22%. So very nice move. We have a look at this. This fund is Wire, which is copper mining stocks, up 20%, same sort of pattern. Global green metal miners, not a very pretty chart to look at. But if we go to a weekly chart, you can see it's still way down from where it was in 2022. But from the low in September, had a nice 28% move. Of course, Aussie miners, let's have a look. So this is a fund that owns Australian mining stocks. So if you watched my previous video from 3 weeks ago, please let me know if you'd like to see that video. You can see from May this year to September, the miners went down 22%. And then same sort of deal in this downtrend channel, positive divergence on the momentum indicators, giving us, if you're aggressive, you're entering here. That's probably where I started entering for a lot of clients, was on this decline. Of course, breakout on the China stimulus and nice move. So the miners are doing, they're probably due for a bit of a breather, but they've done very well. This is OZR, another one that owns bigger Australian mining companies, mainly BHP, Rio, Fortescue, and Woodside. You can see a 19% move in that. Same sort of chart pattern as well, in a downtrend channel, positive divergence on the momentum indicators. All this occurred a week or two before the China stimulus came. So that's not me trying to push any conspiracy theories or anything. I'm just saying, like, the market had been oversold. Chinese stocks were oversold. The market could probably see that the downtrend was coming to an end. It's not a conspiracy theory to say that the Chinese at some point were going to stimulate and prop up their stock market, and they've done exactly that. Whether it lasts long term, who knows? But those are massive gains in a very short period of time. Uh, I have been, I'm not a speculative investor, so my clients and we've been taking profit. Um, I'm not suggesting it's going to crash from here or keep going up. I don't know, and I'm certainly not giving investment advice in this video. I'm just letting you know what we've been doing. So let's keep it moving. Have a look at the price of gold. Gold has done very well. It just doesn't seem to want to drop. I believe this is the best year it's had since 1976 or 79. It's been a very long time. If we have a look at a 1 year chart, well, there was gold a year ago, and gold is currently up 46% over the last year. So it's had an excellent year. Not much to see on the charts here, other than to say it's had a great run and probably due to cool off for a bit. But there's no real sell signal there, other than just common sense that it's had a good run. Silver, on the other hand, doing much better now. You can see I've got a little bit more of a technical chart on silver. Um, you can see that was the low in February of this year. Big run. So there's your flagpole, and you've got your broadening falling wedge or flagging pattern. Key price levels, like at $26, you can see that was the high in December last year. That was the breakout and bounce level in April. Tested it again in May. And then in this channel here, you can see that was an appropriate time to be buying some silver around that 26 key level. Also, not coincidentally, or coincidentally, I guess, at the bottom of that downtrend channel. And then, of course, the $30 level is pretty key. Being a psychological price barrier, the 30 level is kind of hard to get through. It hit there initially, sold off. Then once it broke through, broke out the top of this channel. Now, I guess I would think there's a probability that it's going to come back to test that breakout. Like we saw with let's go back to that wire, that copper. You can see the copper when it's in a downtrend channel, breaks out, tests the breakout, tests the return to the scene of the crime, so to speak. I would say silver may need to do that, although last night it did have a spike high that was a fresh high, and it looks like it closed almost at a fresh high. What's that? The close is 32.44. That close was 32.43. So I guess you could say it closed 1 cent higher than the previous high close for the move. So that would be, I believe, a 10 plus year closing high. Where would we have to go back to see a closing? We'd have to go back to 2012. So that would be a 12-year closing high for silver. This is a monthly chart now. Gold miners, probably not much to look at there at the moment. They're not too many signals on the chart. They've had a good run, but they're mining a little sell-off. Oil is a little bit more interesting. So I don't quite know what to make of oil at the moment. This is a 5-year chart, and we can see the $65, $66, let's call it $66, pretty key level. You can see that was a low in December 2021. It was a low again many times through 2023, and it hit that level the last couple of weeks. Now, I'd still say this looks pretty bearish. This is not good sort of price action. This is the kind of thing you'd expect to see something like that happen. But we've got somewhat of a World War III, unfortunately, occurring at the moment. So that is putting some upward pressure on oil prices. But you can see that it was pretty easy to figure out there was going to be a bounce at this level when we zoom in. You got that 5-year chart. You can see this sort of $66 level was going to be a bounce. And when we zoom into the 1-year chart, you can see it broke below 66 very briefly a couple of times. Seems to be holding that, and now it's made a higher high. And you could argue in the short term that there was a bit of a downtrend there, and it's just maybe trying to break out from that. I know I'm drawing dotted lines here, but that's fine. You can see a pattern like that, sort of a broadening falling wedge pattern. That's generally a bullish pattern. Once it resolves, it hit that key level at 66, and now it's made a higher high and is somewhat breaking out. So potentially, I guess you could say in the short term, it's heading back to test that channel at 80. It may even move to 84, 85 to test the previous high there. But I don't think this is a good time to be participating in energy stocks. And I might just add one more chart here. This is an ETF that owns, let's go back. I've drawn some lines in it. This is an ETF that owns global energy companies. And I haven't been buying energy stocks for clients directly, aside from buying a little bit in the diversified mining funds. And if we do an overlay of the oil chart, and I really don't like this new default color, and I can't seem to change it. You see the black line is the oil chart, and you can see from the lows in 2020, the price of oil and the energy mining companies, global energy companies, in the candles, the price was very correlated, and you can see. I'll line that up a bit better. You can see around mid 2022, the price of oil started to decline, but the energy stocks remained elevated. And I guess that's because we've got this, well, you'd expect the oil price to stay high too if there's all this conflict in the world. But the energy stocks are pretty much trading at the same price they were at when oil was at $113, $115 a barrel, and oil is at 74 at the moment. So I don't know how that's going to resolve. It could be resolved with the oil price going up, or it could be resolved with the energy stocks coming down, or something in between. But I don't know that I see value in that. I'm not saying that these stocks will crash, but for me, I want to buy low, sell high, and the energy stocks, they seem elevated or expensive relative to the price of oil. Now, finally, let's have a look at the Aussie market. The Aussie market is doing, obviously, the China stimulus helped. A little bit of a sell-off to end the week, but that was a all-time record high that was made on Monday, and then just a little bit of a sell-off to end the week. But again, you'd expect, when you get a little breakout there, you'd expect a little pullback to test the breakout. Short-term Aussie market probably a bit expensive. You could say maybe it's trying to break down from that little trend it was in. But long-term, Aussie market has been doing pretty well, and obviously got a boost from that China stimulus. That's probably, aside from the Aussie dollar. So, we see US dollar going up in the short term. Aussie dollar had a great run, and then, of course, a sell-off the last couple of days, although you could argue a case that, this is the breakout level and it's just coming back to test it. I would be a little bit concerned that maybe a more significant top has been put in, as we see those divergent signals on the momentum indicators. And, that US dollar chart is, that's looking like the downtrend, at least for the time being, has come to an end. Now, maybe it'll do this and swing back down to test the lows again. And we see, it sort of going sideways for a few weeks, maybe a month or two before more of a rally. But just be wary of that US dollar strength. A lot of other areas of the market, like we've seen stocks hit record highs, gold hit record highs, China pumping. So it's probably just a time to be a little bit cautious. But anyway, hopefully that gives you a good sort of charting update as to where some key things are at, some key news items. And as always, please feel free to reach out if you'd like to talk about these topics in more depth. And thank you for listening. Cheers.